Now let's look at part B of the question. What it says, if the expected profit after tax of the company for the year ended 31st March 2027 is 50 million, right? What is the expected PAT? 50 million for the year ended 31st March 2027. Without considering any impact on profit from arrangement A and B. Okay, we'll need to look at what is arrangement B because we looked at already arrangement A. Advise the management of Alpha on the impact on the basic earning per share from arrangement A and B above separately, right? So we actually read arrangement A. Okay, so now we need to look at what is arrangement B, and what we need to explain is actually advise the management of Alpha, our company, impact on what? Basic earning per share arising from arrangement A and B separately, right? Don't mix them together. Separately take arrangement A, separately take arrangement B. Right. Shall we look at and complete arrangement A first? Because as we have already read it before reading the arrangement B. Because arrangement A was what? Just to refresh our memory, company issue 200,000 convertible bonds on 1st April 2026, that is at the beginning of the year. These bonds will have 3 years term and these are issued at par. That means face value is 100 rupees. The bonds will be mandatorily converted. Okay, so the arrangement A is this particular bond would be mandatorily converted into how many ordinary shares? 250,000 ordinary shares at the maturity. That means at the end of the 3rd year, this is going to be converted into 250,000 ordinary shares. It's a mandatory conversion. Right? Then we understood interest is payable annually in arrears, where the coupon rate is 6%. Then we also looked at market rate of a similar bond without this conversion yields 9% return. Right. So in this situation, what we now need to explain is what is the impact on the basic EPS. Now let's assume without this particular arrangement, either arrangement O or arrangement B, in the current context, if you look at the current context, what is the basic KPIs of the company? So have you been given the profit figure? Yes, because in the question you have been given the profit figure. What is the profit after tax figure? 50 million. How to calculate the basic EPS? Basic EPS is equal to the profit attributable to ordinary shareholders divided by the weighted average number of shares. So when you have profit after tax, so how to derive the profit available to ordinary shareholders? If you have any preference share dividends, you need to deduct. In this situation, no information about the preference share dividends are given. So that we need to assume that profit after tax is equal to the profit attributable to ordinary shareholders. So the numerator of the basic EPS calculation, now we know 50 million rupees. Then what? That has to be divided by weighted average number of shares. So how many number of shares are outstanding before this arrangement A or B? So that is given actually over here, right? Under the arrangement B, that is given. Over here, currently, if you look at the last line of arrangement B, currently, company has how many shares? 1 million ordinary shares currently. Right, so the currently 1 million shares. Then what is the current basic EPS? If you look at the answer over here, the suggested solution, so it was mentioned over here. So without arrangement A or arrangement B, if you look at the current context, right, profit attributable to ordinary shareholders, which is equal to the profit after tax 50 million, divide by weighted average number of shares, means number of shares that the company has issued, which is 1 million. 50 million rupees divided by 1 million, basic EPS currently, right, current basic EPS, this is basic EPS currently is this much. Now what will happen? There are two arrangements. arrangement A and B. Now we need to individually assess, separately assess what is the impact on this basic EPS, right? So let's look at the arrangement A first. Let's look at the arrangement A first. There are two arrangements. Arrangement A, we already read it, right? So what is the impact? So listen this carefully. When you have mandatorily converted instruments, like what? There's a bond that's definitely, that particular bond will definitely be converted into ordinary shares in 3 years' time. So when you have such instruments, right, when you have such instruments, when you do the computation of basic EPS, what you need to do is the number of shares that would be issued upon conversion of this mandatory convertible instrument, you take into the computation now itself. You assume that this conversion is already been happened. Even though it's not happened yet, it will be happening in 3 years, but we know for sure that that will definitely happen. It's a mandatory conversion, not an option. So because of that, when you are calculating your basic EPS, you have to assume that the conversion is already happened. In that situation, what is the number of shares, additional number of shares that the entity is going to issue? In this case, it's clearly mentioned, upon the mandatory conversion, how many additional ordinary shares would be issued? 250,000 ordinary shares will be issued. So what will happen is, our existing number of shares are how much? 1 million, right? Existing number of shares are 1 million. Number of shares. Right? Existing 1 million. Then upon mandatory conversion, there will be new ordinary shares. How many new ordinary shares? 250,000. Altogether, 1,250,000 ordinary shares will be available, not today, but definitely on a future date, but for the basic EPS computation, now itself you adjust it. Right? Your denominator will go up from 1 million to 1,250,000. Right? Okay. Then, impact on the numerator. What is the numerator? Profit attributable to ordinary shareholders. At the moment, that is profit after tax. Profit after tax is 50 million. Then, with regard to this particular instrument, what I am talking about, would it result any impact on the profit after tax figure? Because it's clearly mentioned in the question over here. If you read the question, this profit after tax figure in part B, it's clearly mentioned expected profit after tax of the company for the year ended 31st March 2027 is 50 million without considering any impact on profit from arrangement A or B. Now, we are discussing about arrangement A. Does arrangement A has any impact on the profit after tax? Because you remember, when you are discussing arrangement A, we decided to split the amount what you received by issuing this mandatory convertible bond into two components: financial liability and equity. Right? So what was the financial liability value? If you go to the suggested answer, what was the financial liability value in arrangement A? We split, we have done the computations. Over here, financial liability value of this much, 3,037,554. Equity value of this much, 16,962,446. Then, what is the year that we are talking about? For the year ended 31st March 2027. On this financial liability, how much of finance cost that we have recognized? We worked out. For the year ended 31st March 2027, we recognized a finance cost of how much? 273,380. Finance cost, what's the double entry? I explained. P&L debit, credit where? financial liability. P&L debit means what? There is an impact on the profit after tax. So the profit after tax, the given figure is 50 million. When you charge this finance cost, there will be a small reduction in the profit after tax. So in your computation of the basic EPS, numerator has to be the profit after tax figure, what is given in the question, 50 million minus this figure. That's how you do the computation. So if I go back to the place where I was at, so what is the value? 273,380. Right. So over here, that is given. So you know what is the impact on your denominator? Number of shares will increase from 1 million to 1,250,000. On your numerator, profit for the year, 50 million, right? 50 million. From that, you deduct interest. Interest on the financial instrument. How much is that? 273,380. So once you deduct finance cost from the profit after tax, so what is the remaining amount of the profit after tax? 49,726,620. Right? That has to be your numerator. So basically, under arrangement A, your basic EPS. So this is arrangement A, right? Arrangement A. Yeah. Under arrangement A, basic earning per share would be how much? 49,726,620. That is the profit attributable to equity shareholders after deducting the finance cost, divide by how many number of shares? 1,250,000 shares. So what is the value? 39.78. So your basic EPS would come down from earlier how much? Earlier, straight away 50 million profit after tax divided by 1 million shares. It was 50 rupees per share. Now, if you implement arrangement A, your basic EPS will come down from 50 rupees per share to 39 rupees and 78 cents. Are we clear? Right, that is the answer to. So what was the question? If you look at the question, part B, if the expected profit after tax of the company for the year ended 31st March 2027 is 50 million without considering any impact on profit from arrangement A or B, advise the management of ALPA impact to the basic earning per share arising from arrangement A that we discussed. Thereafter, we have to independently, separately take arrangement B and explain yet again what is the impact on the basic EPS. Because without taking any arrangement A or B, what was the basic earning per share? 50 rupees per share. Now we looked at in arrangement A, it will come down to 39 rupees and 78 cents. What if not arrangement A, if arrangement B is implemented? That is a separate part. Right? Now we need to read what is arrangement B is. We haven't read arrangement B because arrangement A already we discussed in part A. So that's why it was easy. There's nothing much to read. We just need to answer to the question. Right? Okay, let's look at what is the arrangement B is now. Arrangement B. Now earlier mentioned that the whole purpose is company is going for an expansion. So company wants to raise finance. So the arrangement A is about issuing mandatorily convertible bond for 3 years. Then it's getting mandatorily converted into ordinary shares. So what is the arrangement B? Rights issue will be carried out. Here, not a bond issue, rights issue. Rights issue will be carried out by issuing 1 new share for every 5 ordinary shares. Okay. What is the arrangement? 1 new share for every 5 outstanding ordinary shares. 1 for 5. Okay. So what is the arrangement? 1 share for 5 shares. Okay. the exercise price will be 50 rupees per share. Exercise price 50 rupees per share. Market price of the ordinary share immediately before the exercise is expected to be 110. Okay, market price of the share immediately before the exercise of the rights, how much? 110 rupees. This is the expectation. So it's mentioned earlier, currently company has 1 million ordinary shares in issue. New shares are expected to be issued on 30th June 2026, right? So the rights issue, the date of issuing these new shares are also important for the computation, especially for the computation of weighted average number of shares, because this is for the financial year ended 31st March 2027, right? So these rights issue shares would be issued on 30th June 2026. That means financial year begins from 1st April 2026. After 3 months from the beginning of the financial year, so these rights shares would be issued. Right, so what we do? We have to do the computation. Now, when you have a rights issue, what will happen is, always in the basic EPS computation, we need to look at impact on the numerator and the denominator. Now, numerator is what? Profit attributable to ordinary shareholders, or the profit after tax figure, which is 50 million currently. Rights issue doesn't have any impact on the numerator. So your numerator won't be changed. It is 50 million. So the rights issue would change your denominator, weighted average number of shares. There will be new shares issued, right? So under LKS 33, we learned when you have a rights issue, it has the cash element as well as the bonus element. What does that mean? Normally what will happen, forget about the rights issue. You issue shares for cash. Let's assume not a rights issue, you have issued some shares for cash. It's a normal share issue, not a rights issue, not a bonus issue, normal share issue on 30th June 2026. What will happen to the weighted average number of shares? You take these new shares into the computation of the weighted average number of shares from the date of the issue. Right? Because why? From the date of the issue, from company's point of view, company would receive cash. So company can use this cash for the earnings generation activity from the date of the issue. So these shares which are issued for cash would be taken into the weighted average number of share calculation from the date of the issue. Right? That means you adjust the weighted average number of shares prospectively for the shares issued for cash. Now let's assume a bonus share issue. Bonus share issue means what? You are giving shares, or you are issuing shares, company is issuing shares to the shareholders free, without any corresponding resource inflow to the entity. Right? They have reserves. By using that reserves, company has issued bonus shares. Now let's assume a bonus share has been taken place on 30th June 2026. Now tell me, when you are calculating the weighted average number of shares, how are you going to adjust that? Are you going to take from this date, that means from this date to the year end, 9 months? Or else, are you going to assume that these bonus shares were always in issue? In other words, are you going to adjust this bonus shares prospectively from the date of the issue, or else are you going to adjust retrospectively? You adjust retrospectively. You assume that these are always there. Even in the first 3 months, these shares are there. Even in the comparative period, last year, these shares are there. Because why? With the bonus issue, even though the number of shares has gone up, there's no corresponding resource inflow. There are no resources coming into the company. There is no impact on the earnings generation. So because of that, if you adjust prospectively, that is wrong. So you adjust retrospectively. Cash share issue, prospectively. Bonus issue, retrospectively. That's what we learned in LKS 33, earning per share standard. But in this question, what do we have? Not a cash share issue or not a bonus issue, but a rights issue. What is the specialty of the rights issue? Rights issue has both these elements, cash component and bonus component. Then what we need to do? Cash component you adjust prospectively, bonus component you adjust what? retrospectively. That's what you need to do. Okay, so how to do that, we'll look at it in a little while. Because why do I say that there's a cash element and there's a bonus element? Because now rights issue means what? Company is issuing shares to its existing owners. Now in this situation, company says, we will issue you are the existing owners of the company, we will issue you shares at 50 rupees per share. But before the rights issue, the expected market price of the share is 110. Right? That means if you are a shareholder, you would love to take it, right? Because why? Share prices goes at 110. You are given a new share for every 5 existing shares at 50 rupees per share. So the rights issue you give to the shareholder with a discount. Because immediately before the rights issue 110, but you give the share to the shareholders at 50 rupees. Now you see the cash element and the bonus element. Cash element means what? You collect something. There are certain amount of resources flowing into the entity. That has an impact on the earnings generation. That has to be adjusted prospectively from 30th June 2026 onwards. But there's a bonus element as well. Because why? You don't collect the full amount of the share price. You are offering a discount to the shareholders, existing shareholder. That is the bonus element. That element you need to adjust retrospectively. Always it was there. So that is the logic. Again, I'll just show you. We discuss all these things. No time for us to go through theory tudes. This is what I mentioned, how to calculate the basic EPS, and thereafter we discussed about the full market share issue, that is cash share issues, then the bonus share issues. Thereafter, this is what I just mentioned to you. Right? Rights issue has special features. There are additional resources coming into the company, but they are normally priced below the full market price. So therefore, they combine the characteristics of issue at full market price, that is at cash, and bonus issues. Okay, full market share issue and the bonus issue. It has a combination of characteristics. Right, so let's do the computation then in this situation. So the challenge is what? Now we are discussing about arrangement B. In arrangement B, how to calculate the basic earning per share. In basic earning per share, in arrangement B, there is no impact on the numerator. Earnings attributable to the owner shareholders, or else profit after tax in this situation is 50 million. That's not going to be changed. But the weighted average number of shares are going to be changed. Right? At the moment, how many shares that the company has in issue? At the moment, 1 million ordinary shares. 1 million ordinary shares. Then, what is the rights issue ratio? Every 5 shares, 1 new share. That means for 1 million shares, how many new shares? 200,000 new shares. Okay, for 1 million shares, 200,000 new shares will be issued. Right? Then how I am going to take that into the weighted average number of ordinary share computation? We'll do this quickly. You have to prepare a schedule, right? I would say date. Number of shares. Okay. Time period. All these things we discussed. Time period. Then the special adjustment, I'll explain this. Bonus fraction. Then the weighted average. Weighted average. Right. So this financial year starts from 1st April 2026. At the beginning, up until 30th June 2026, how many shares were there? 1 million shares. 1 million shares. 1 million shares were there for how many months? Up until 30th June. From 1st April 2026 to 30th June. What is the time period? 3 upon 12. 3 months out of the 12 months, we had a situation of 1 million shares. Okay, for the time being, forget about the bonus fraction. I'll come to that. And the weighted average also keep it black. Then what will happen? 30th June 26. 1 for 5 share issue. 1 for 5 share issue. That means we had 1 million shares. Every 5 shares, 1 share would be issued. Divide this by 5. Multiplied by 1. That means 200,000 shares are issued as the rights issue. So then, what is the total number of shares? We had 1 million. Additional 200,000 shares are issued. In total, now we have 1,200,000 shares. So 1.2 million shares. Up until the year end, from 30th June 2026, we had how many shares? 1.2 million shares. So that means what is the time fraction? This is time period or time fraction. Okay, you can mention time period or time fraction. 9 upon 12. For 9 months, from 12 months, 9 months, we had 1.2 million shares. Are we clear? Up to now, okay. Then, you see, if you look at the newly issued shares, the rights shares are included in the computation for last 9 months. No? If you look at last 9 months, 200,000 new shares issued under the rights issue is included. But first 3 months, so these 200,000 new shares are not included. But what we discussed, the rights issue has a bonus component. We need to now calculate what is the bonus component of the rights issue. So that is your bonus fraction. I'm going to calculate the bonus fraction. Okay, so for that you have to do a small working. What is it? What you do is, you first of all calculate the theoretical, something called theoretical exercise price. So how to calculate the theoretical exercise price? I am going to derive the bonus fraction. No? Theoretical X right price. How do I calculate that is this? What do? You take, now, what is the rights issue ratio? A holder who has 5 shares would get 1 share free. Sorry, not free. Holder of 5 shares would get 1 share as the rights issue. Immediately before the rights issue, what is the share price? Expectation is 110 rupees per share. So the rights issue is taken place at 50 rupees per share. So a holder of 5 shares at the price of 110 will be given 1 share at 50 rupees. Am I correct? Holder of 5 shares at 110, okay, will be given additional share, 1 share. Holder of 5 shares at 110 will be given additional 1 share at the price of 50 rupees. Okay. All together, now he has how many shares? 6 shares. Holder of 5 shares at 110 is given 1 rights share at the price of 50. Altogether, now he has how many shares? 6 shares. Divide this by 6. What is the answer? Rupees 100. 100 rupees. So the theoretical ex-right price, that is theoretical computation of the share price. After the rights issue, it would be 100 rupees. Theoretical, yeah? So this is a computation, theoretical ex-right price. Ex-right means after rights. Then you need to calculate not the theoretical ex-right price, what I am interested, bonus fraction. Then the computation of bonus fraction is very simple. Bonus fraction. How do you calculate the bonus fraction is, you take the share price immediately before the rights issue. What is the share price immediately before the rights issue? Expectation, rupees 110. That you divide by theoretical ex-right price. What is the theoretical ex-right price? Rupees 100. Or in simple language, 110 divided by 100. What is my bonus fraction? 1.1. My bonus fraction is 1.1. Okay. What do you do is, I told you, going back to the computation, now this rights share or the rights shares, 200,000 rights shares are included into the weighted average number of share computation from 30th June 2026. So that means last 9 months, 200,000 shares are included. First 3 months, 200,000 shares are not included. What we need to do? We know within a rights issue there's a cash element and there's a bonus element. Cash element you adjust prospectively. That means from 30th June 2026 onwards. But the bonus element you need to go back and adjust. Go back and adjust means this 1 million shares I need to adjust for the bonus fraction, which means I have to multiply that by 1.1. What is 1.1? This number which I derived. Right? Then what I do is, I multiply 1 million shares into 3/12 into bonus fraction. Right? 1.2 million shares into 9/12. Here there's no bonus fraction because from this date onwards, 200,000 shares are included. So again, don't multiply by the bonus fraction. So the bonus fraction is used for the shares that was there before the rights issue date. So that's why we multiplied 1 million by the bonus fraction. So now what is the weighted average? What is the answer that you get? 1 million into 3/12 into 1.1. How much? 275,000. Then 1.2 million shares into 9/12. How much? 900,000. Then what do you do? 275,000 minus 900,000. What is your weighted average number of shares? 1,175,000. 1,175,000. So this is your weighted average number of shares in the basic EPS computation. Simple. Right, okay. Let's go back to the answer. Right. Let's go back to the answer with regard to the rights issue. I have explained everything. Right. So what is the weighted average number of shares? 1,175,000. How I derived, I have explained. Right. So here in the suggested solution also there's a, so how it is derived, it is there, but use what I have done. Right. So this is what they have done is a bit complicated. Don't go there. I explained what to do, and also I explained that in the theory tutor as well. So ultimately weighted average number of shares are 1,175,000. Then how to calculate the basic EPS? Basic EPS is equal to profit attributable to ordinary shares. Should have been calculated somewhere. Where? Okay, here. Accordingly, earning per share is equal to profit attributable to ordinary shareholders. So profit after tax figure. Numerator is not going to be changed, which is 50 million. Now we calculated the weighted average number of shares, 1,175,000. Your basic earning per share would be 42 rupees and 55 cents. So before, this is the arrangement B. Before the arrangement, basic earning per share was 50 rupees. Now, if you go ahead with the arrangement B, basic earning per share will be reduced to 42.55 cents. So if you look at these two options, arrangement A and arrangement B, earlier we looked at in arrangement A, that is mandatory bond issue. What was the basic EPS? This is arrangement A and this is arrangement B. So if you look at EPS perspective, arrangement B, which is the rights issue, would be better because arrangement A would reduce your basic EPS up to 39.78. Arrangement B will reduce your basic EPS only up to 42.55. Okay, right. So yeah, accordingly, the earning per share will be reduced by a comparatively higher amount due to the issuance of compound financial instrument. That is arrangement A. If you issue compound financial instrument, that is convertible bond, your basic EPS would drop by a higher amount compared to you do a rights issue. Right? Okay, so that is the answer for part B. Yeah. So part A we have done it, part B, that is the answer for part B we discussed. Okay. Right, so this is actually the question number 4 of the pilot paper. If you look at part C is with regard to the sustainability reporting. Advise the sustainability manager on the activities that he or she should carry out to assess the requirements of SL-25-1 in terms of the governance against the current governance practices of alpha. So this part would be covered by the lecturer who is doing the sustainability reporting aspect, right? So with that, actually we have completed the entire pilot paper other than the sustainability and the digital areas, which are covered by the expert lecturers who are doing those areas. So it is so overall, what do you say? Simple if you know the theory. So be thorough with the theory. If you are thorough with the theory, I actually shown you when I'm answering the questions, always I showed you the theory towards, that is to build your confidence, right? So ensure that you know the theory and also practice some questions up until the examination, then you will be well prepared for the examination. Right, with that we are done with the pilot paper issued by CS Sri Lanka in January 2026, targeting for June 2026 SL1 examination. Right.